Episode 4, April 9th. Yesterday, the market had a full-on rip. SPY up 2.5, QQQ nearly 3, IWM nearly 3. Oil crashed 9%, the Fed minutes came out, and traders took the dovish reading and ran with it. This morning, oil is bouncing back, futures are softer, and core PCE drops this morning. Tom, Ray, morning.
Yeah, still here. They keep letting me back on. Not sure what that says about any of us.
Tom, man, it says we either have a very high threshold for pain, or, well, we just haven't found anyone else who'll wake up this early with us. Good to see you, man.
Morning. I actually shortened the bagpipe intro today. It's only 7 minutes now. Cultural compromise.
7 minutes? Tom, that's not a compromise. That's a hostage situation. I think our listeners are going to need an extra pot of coffee just to survive the short version.
7 minutes. Right, so before we get into yesterday's tape, we have a couple of predictions to settle. Mine first. Episode 1, I said the 10-year walks toward 450 after the FOMC minutes. The 10-year is at 429 this morning. It went the wrong way. Oil crashed, the dovish read won, yields came down. I was wrong. Tom, you said AAPL finishes red even if QQQ holds above 2%. QQQ closed nearly 3% up. AAPL closed up 213. Also wrong. Tom's NVDA call is still live. That one's conditional on Friday's CPI print, so we come back to it then. Now, yesterday was genuinely one of the bigger sessions we've had in a while. Everything ripped. Oil tanked 9%. The Fed minutes came out and the market took the most optimistic possible reading. And this morning, oil is bouncing back, futures are softer across the board, and core PCE hits at 830. Gold held its bid through all of it, up 60 cents while everything else ripped on risk on. Crypto caught the move too, BTC and ETH both up on the day while Coinbase barely moved. So was yesterday real, or did we just price Goldilocks and now have to live with the hangover?
Yeah, it was both. The oil move wasn't just nice to have. It mechanically dropped inflation expectations in one session, so yields fell, and that's oxygen for anything long duration, which is basically your entire AI complex. Meta plus 6.5, AMD plus 4.6, NVDA still lagging at plus 2.2. That's not random. That's flows chasing the stuff where earnings are furthest out and most sensitive to discount rates. The problem is, if core PCE comes in hot, that whole chain just runs in reverse, yields back up, and suddenly paying 30 to 35 times for future AI dominance feels ambitious. And oil bouncing this morning is the market gently remembering why it panicked in the first place.
Tom, you're spot on about that oxygen, but man, it really feels like the market only read the headline of those minutes and then just went out to recess. Everyone saw oil drop nearly 10% and decided the Fed's job was basically over. But if you actually look at the footnotes, they're talking about no rush, and some of these guys are even whispering about hikes if the data doesn't behave. We're sitting here with the 10-year at 429 because the market is desperate to price in this perfect Goldilocks scenario. But my whole inflation basement thing is that just because the living room feels cool doesn't mean the furnace isn't still redlining. Core PCE this morning is the real smoke detector. It's going to show if that basement is still smoldering regardless of what oil did yesterday. If that number comes in even a tiny bit hot, all that oxygen for the AI names is going to get sucked out of the room before the opening bell even rings.
The tape is up next. Back in a second. The tape. Yesterday was a buy everything session. SPY, QQQ, IWM, all up close to 3%. Oil crashed 9. AI names led. Let's work through it.
Yeah, it was one of those everything works, except the thing that doesn't days. The key unlock was oil nuking nearly 10%. That's not just energy down, that's the market going, inflation problem, maybe not, which pushes real yields down, and suddenly all these long-duration AI cash flows get repriced higher at the same time. Meta, plus 6.5, is basically ad plus AI operating leverage. They've already cut the cost base, so every incremental dollar of revenue looks like magic now. And AMD plus 4.6 is the second source AI trade where people realize NVDA can't be the only shop in town. You could feel the rotation into anything that even whispers accelerator. TSLA being read in a plus 3% tape. That's the Tesla gravity arc, right? When the market's in full duration party mode and you still can't catch a bid, it's because you're being quietly reclassified from future tech platform to car company, but ambitious. And those only go up when the story gets louder than the math, which it didn't yesterday.
Tom, the TSLA thing is such a tell. It's like the market finally looked at the window sticker and decided they'd rather just buy the factory instead. But look at those cyclicals. XLI and XLB ripping over 3% is really about that 10% oil crash acting like a massive, unannounced tax cut for the whole industrial base. That drop cooled inflation expectations, which dragged the 10-year down from 434 to 429, and let the small caps in the IWM breathe because their debt suddenly didn't look so heavy. The thing is, it makes the Fed look like they're swinging a sledgehammer at a Swiss watch, especially with those minutes talking about hikes, because the AI sector is building out through long-term power contracts that are basically immune to the Fed's hammer. So the sledgehammer just hits the floor while the watch keeps ticking.
And crypto caught the same bid. BTC and ETH both up on the day, but Coinbase barely moved. Tom.
Yeah, that's the market telling you it trusts the asset, not the business. BTC's a pure liquidity sponge. It just absorbs flows. Coin's a spread business with costs, regulation, and users who disappear the second volatility dries up. You got a plus 3% move in the thing, and the toll booth didn't get paid. That's not enthusiasm, that's hesitation.
It really is the ultimate barometer for the "is the tap open" question, because Bitcoin reacts to global liquidity in real time without the noise of a CEO or an earnings report getting in the way of the macro signal. When it moves and the businesses around it don't, it's just the market saying the cash is sloshing around, but the actual economic conviction is still missing.
Footnotes up next. Footnotes. A few things that didn't fit in the tape but matter for what happens next.
Yeah, oil down almost 10% and then just quietly up this morning like nothing happened. That's not a regime shift, that's positioning getting carried out. Too many people leaning the same way and the exit door got small. If it was actually demand collapsing, it wouldn't bounce. It would just sit there and look ill.
And the Fed minutes that everyone celebrated yesterday. Ray, what did they actually say?
It's like the market read those FOMC minutes and only highlighted the parts in bright yellow. We get this 3% rip and the 10-year slides down to 429 just because the Fed didn't explicitly take rate cuts off the table for this year. But even with everyone celebrating, if you actually look at the basement, the furnace is still running hot. We're seeing no rush language and even whispers of hikes in the fine print, which tells me the market is choosing to ignore the heat downstairs because it's desperate to believe the living room is finally cooling off.
Gold held up through all of it. GLD up 60 cents yesterday in a risk-on tape and barely budged overnight. Ray.
It's actually something to watch gold just shrug off a 9% oil crash like it's nothing. Usually that kind of risk-on move sees the havens get liquidated to fund the equity rip. But holding firm here tells me the market is looking past the piece headlines and seeing the structural mess underneath. The liquidity is shifting, but the fear hasn't actually left the building. And Alex, I hate to be the one to check the scorecard, but GLD is at 434 pre-market. So you're going to need a pretty big move to get above 440 by Friday.
The SEC. A lawmaker wants them to probe suspicious trading right before the major Iran war headlines. Tom.
We only notice suspicious trading when the headline hits. Before that, it's just called being very well informed. New enforcement head gets to discover that in wartime, information leaks faster than policy, and somehow always in the direction of profitable timing.
And Dalio said the Trump-Xi meeting, if it happens, won't just be about tariffs. It'll be about capital flows. Ray.
Dalio is always there to remind us that it's never just about the soybeans. When he says capital flows, That is such a massive shift in language compared to just talking about tariffs. Because trade is what we buy from each other, but capital flows are the plumbing of the entire global economy. If they're negotiating where money is allowed to be parked, they're talking about who funds whose debt. And if China reroutes capital away from U.S. treasuries over semiconductor export controls, then the cost of money for every American goes up because yields have to rise to attract new buyers. It's the difference between a spat over a grocery bill and a fight over the joint bank account. And the bank account is what actually sets the interest rate on your mortgage.
Nerd Corner up next. Nerd Corner. Tom, yesterday Meta was up 6.5% in a single session. That's not a small move for a company worth $1 trillion plus. Walk us through what actually happened there. Rate trade, earnings story, or both?
Yeah, it looks insane on the surface. 5 basis points in the 10-year, and Meta decides it's a growth stock again. But the mechanics are actually pretty clean. When you've got a business with very high incremental margins, and most of the value is in cash flows 5 to 10 years out, the discount rate matters a lot more than it does for, say, a bank. You drop the 10-year from 434 to 429, and the equity risk premium compresses at the same time. Suddenly that 35 times doesn't screen as expensive. It screens as tolerable if growth holds. And Meta specifically, they've already done the hard part. Costs are cut. CapEx is the only real swing factor, so every incremental ad dollar falls through at a high rate. So when rates fall, the market doesn't just re-rate the multiple, it also quietly pulls forward confidence in operating leverage. That's how you get a 6.5% move out of what looks like a tiny rate shift. But at 35 times, you are absolutely underwriting that ad growth stays resilient and AI actually improves monetization, not just engagement. If PCE comes in hot and yields snap back, that whole duration trade dressed up as fundamentals unwinds very quickly.
Tom, that tolerable line. It's just so perfect because it captures how desperate everyone is to stay in the pool. But think about the physics of that for a second. We're talking about 5 basis points, which is basically a rounding error in any other era, swinging a $1 trillion company by 60 or 70 billion in market cap. It means the Fed isn't just using a sledgehammer anymore. They're playing high-stakes operation where the slightest twitch sends the whole patient into a frenzy. If the entire AI narrative is that sensitive to the 10-year, then it's not really a story about chips or software. It's a story about the cost of capital disguised as a revolution. Well, if you're underwriting 35 times earnings on the assumption that rates stay pinned at 429, you're not an investor. You're a volunteer for the Fed's next experiment.
Tom, so is there a real fundamental story underneath all the rate math? Or is AI just a rate trade with good marketing?
It's both, which is what makes it interesting and dangerous at the same time. Meta's incremental margins are real. When you've already paid for the engineers, the servers, the content moderation, every ad dollar at the margin is basically free money. And the CapEx cycle is real. NVDA isn't selling chips to people who think rates are going to 3%. They're selling them to hyperscalers locking in 10-year nuclear power contracts. But at 35 times, you're paying for both the fundamentals and the assumption that the Fed doesn't move. The fundamentals alone, maybe that's a 25 times business. That gap, that 10 turns of multiple, is purely the rate trade. And that's the piece that snaps back hard if PCE is hot this morning.
Calls are up next. Calls. Tom, you're up.
I'll stick with it, but tighten it. If core PCE and CPI both come in even a tenth hot, NVDA is sub 165 by Friday close. Not because anything broke, just the discount rate moving against a trade that assumes perfection. The whole AI stack is priced like cash flows arrive early and smoothly. You nudge rates up, those cash flows get pushed out. Multiples compress first, fundamentals get asked questions later. And NVDA is the one everyone actually has profits in, so it's the one they sell.
Ray, look, I'm clearly getting humbled on that gold call. GLD at 433 is not 440, so I'll take that on the chin. But honestly, it's making me more convinced about the 10-year move. My call is the 10-year finishes the week above 445. CPI is a different beast from PCE, heavier on shelter and services that just aren't budging, and the market is pricing in a victory lap the data isn't going to allow. I know, I'm doubling down on the pain. But when that CPI realization hits on Friday, the long end of the curve is going to snap back because investors will finally see the disinflation narrative is hitting a very real brick wall.
My call, if core PCE comes in hot this morning, QQQ gives back more than half of yesterday's gains by the close. The whole rally was a rate trade, the data is the test, and the market moved too fast to unwind gracefully if it's wrong. We find out very shortly. That's episode 4. Find us on Spotify, Apple Podcasts, YouTube, and if you've made it this far, you clearly enjoy watching 3 people argue about the Federal Reserve before breakfast. We're 3 clowns. See you tomorrow.